There's a specific retirement strategy that academics love and is backed by loads of data. But most retirees, they're a bit skeptical. Not because they're wrong, but because the financial world trained them to think differently. Today, we're unpacking why a strategy with massive benefits on paper often feels wrong in practice and what to do about it. The strategy we're diving in today is guaranteed income in retirement. One of the biggest transitions retirees face is going from an income based mindset while working to an asset based approach in retirement, where you're suddenly tasked with making a lump sum last for decades. And while guaranteed income sounds great in theory, many retirees view it with a lot of skepticism. It's often seen as a strategy for the overly cautious, something that trades long term growth for short term comfort. Why lock money up in something that might underperform the market? But here's the twist: a growing body of academic research says the exact opposite. Strategically using guaranteed income sources like Social Security, pensions, and even select income annuities has been shown to improve both psychological well being and quantitative retirement outcomes. Now, let me be clear, this isn't a sales pitch for annuities. In our practice, we recommend income annuities maybe 5% of the time. But every retiree faces key decisions around guaranteed income, especially with Social Security and pension decisions. This video is simply meant to offer some food for thought, grounded in real research, as you make some of these critical decisions yourself. This gap between what research suggests and what retirees actually do is often called the annuity puzzle. But I think it's more accurate to call it a guaranteed income puzzle. Because when researchers ask retirees what they value, their answers are clear: predictable income, freedom from worry, protection against outliving their money. In fact, studies show that more than half of participants often say they'd like to buy an annuity when it's described by its features, but when it comes to time to act, only about 12% actually do. Now, why? The decisions retirees make often create a kind of cognitive dissonance. They want security, but choose flexibility. They want peace of mind, but opt for market exposure. This chart breaks it down. Research suggests retirees should aim to cover not just their essential expenses, but even a portion of their discretionary spending with guaranteed income. Imagine the peace of mind that comes from knowing that not only your basic needs are covered, but even some of your lifestyle wants are also covered no matter what the market does. Yet in reality, most retirees only cover the bare essentials, leaving everything else riding on portfolio performance. This can carry an underestimated cost for many. So why the disconnect? It comes down to some very real emotional roadblocks. Loss of control. Retirees don't want to give up access to their assets. Complexity and lack of trust. Many guaranteed income products are opaque and certainly feel sales driven. And there's some truth to that. Overconfidence, believing they can outperform the market and self-manage income. And then finally, longevity underestimation, thinking they'll live to 75 when there's quite decent probabilities, especially with medical improvements, that age 90 and beyond is quite possible. Understanding these psychological barriers is the key to making better, more aligned decisions. But let's start with a practical question here. What does the research say about how guaranteed income affects retirement? Not just your ability to spend safely, but also your ability to leave a legacy. Because this is often the sticking point. Retirees will say, sure, I know I could trade $500,000 of my portfolio for guaranteed income, maybe through an annuity or by delaying Social Security. That might make my spending more secure, but doesn't that mean giving up what that money could grow into? Maybe millions if I just invested it instead. That's a fair concern. But some compelling research pushes back on this idea. On the screen, I've listed 3 academic papers, just a few of many, that offer a different perspective. First, Milvisky and Young's 2007 paper shows that annuities aren't just about protecting you, they can actually help your heirs. Without annuities, your wealth at death is highly unpredictable. If markets do well or you pass away early, there might be a lot left over. But if you live a long time or hit a stretch of bad returns, your portfolio could be gone. That volatility makes legacy planning quite difficult. By using guaranteed income to cover your essentials, you reduce the need to constantly draw from your portfolio. That gives your remaining investments room to grow more steadily for future discretionary spending or to leave behind. Then there's Wade Pfau's work, which adds a really interesting layer here. He applied something called the efficient frontier, a core concept in investing, to retirement income. Now, in simple terms, the efficient frontier is a way to find the best possible balance between risk and return. Imagine a curve that shows the most efficient portfolios, those that give you the most expected return for the least amount of risk. Pfau asked, what if we apply this to retirement income, balancing income certainty with long-term asset growth? What he found was quite surprising. Many retirees actually give up growth in exchange for safety by holding a lot of bonds or cash. But When he modeled replacing some of those safe assets with SPIAs, single premium immediate annuities, the result was a more efficient retirement plan. Retirees could meet their income needs more reliably and often leave behind more wealth at death. The takeaway here, guaranteed income isn't just a safety only play. Using it strategically can help you spend more confidently today and actually grow your legacy for tomorrow. It's not about giving something up, it's about planning more effectively. Now, I'm not an academic researcher, but we found a very similar result to Pfau's work in a previous video series we did called 5 Retirement Distribution Strategies. In that series, we compared 5 different retirement income strategies. 2 of them, the pro rata method and the traditional glide path, are the most commonly used in retirement planning. But the one I want to highlight here is the quote unquote safety first strategy. In this approach, the retiree starts with a $1 million portfolio and a $3,000 monthly Social Security benefit. They delay that Social Security benefit until age 70, and then they use an income annuity to floor their remaining income need. The rest of the portfolio is invested in a heavily equity-weighted allocation. Now, here's the surprising part. Even though the annuity reduces the initial investable balance, the ending portfolio value was quite competitive to some of the other strategies or best performing strategies. It reported the second highest on average across all 5 strategies. And when we looked at how often each strategy ended with a large portfolio, defined as over 300% of the starting balance, the safety first strategy was tied for the top spot. The key takeaway, guaranteed income doesn't automatically mean you're giving up that growth. When used intentionally, it can create the stability needed to take smarter risks elsewhere and often with better long-term results. Now let's look at a more recent paper from Michael Fink and Wade Pfau, which compares 2 ways to generate guaranteed retirement income. They analyze what it would cost to fund a $20,000 annual income using a Treasury bond ladder based on yields as of April 2024. Treasury ladders are often seen as a low-risk way to mimic guaranteed income. To fund that $20,000 for 25 years, the bond ladder would cost about $350,000. Now, here's the interesting part. That same couple could instead purchase a fixed immediate annuity, which would provide $20,000 per year for life, not just 25 years, and it would only cost around $270,000 based on current pricing. So not only does the annuity provide lifetime income, it also frees up roughly $77,000 in capital. That surplus could be used for discretionary spending, invested for future growth, or reserved for legacy goals. For retirees already allocating a portion of their portfolio to quote unquote safe assets like bonds, this presents a compelling case. You might be able to secure more income for less money with greater longevity protection by using other sources instead. Now, so far we've focused a lot on income annuities, but if you find this research compelling, I encourage you to start with one of the most valuable sources of guaranteed income that you already have, Social Security. In a 2014 paper titled, "Does it make sense to delay Social Security?" researchers found that delaying Social Security offers a real inflation-adjusted return of 5 to 7% per year, a rate that outpaces most quote-unquote safe assets. And the benefits of delaying are even greater for, number 1, high earners, where the base benefit is larger, and number 2, married couples, where spousal and survivor benefits come into play. Now, here's something even more eye-opening. If you tried to replicate delaying Social Security with a private annuity that includes inflation protection, it would be prohibitively expensive. In fact, Social Security is one of the few places in retirement where the pricing actually favors the retiree. It's a mispriced asset in your favor. On the chart shown here, Wade Pfau compares the legacy value of claiming Social Security at age 62 versus age 70 using historical stock and bond returns. The assumption here is that this retiree lives into their 90s, which might seem like a stretch for some. But the odds might surprise you. For a married couple, there's a 44% chance that at least one spouse will live to age 90 based on population averages. If both spouses are healthy non-smokers, that probability jumps to over 70%. So to some, delaying Social Security might feel like a bit of a gamble, but in many cases, it's actually a smart hedge against one of the biggest risks in retirement, longevity. And as you can see on the screen, can leave more money left at the end if you live a long enough life. Now let's turn to some insightful Social Security research from David Blanchett, which further highlights why guaranteed income planning should often start with Social Security first. In this paper, Blanchett examines the break-even returns needed to make early claiming more favorable than delaying, especially in the context of spousal decisions. He modeled several strategies where one spouse claims early while the other delays to age 65, 67, or 70, and asked, what rate of return would a retiree need to earn to match the income benefits of simply delaying Social Security? The results? The implied returns from delaying are incredibly strong, often in the 7 to 9% range, even before factoring in the full risk-free nature of Social Security. That aligns with the earlier research we discussed, showing that delaying Social Security offers returns well above most safe assets and certainly beyond what private annuities with comparable inflation protection could provide. On the chart to the right, Blanchett illustrates this point very clearly. Even under standard life expectancy assumptions, the break-even return from delaying hovers around 7% or more. And when life expectancy is extended by just 3 years, say for a healthy non-smoking couple, the break-even return jumps as high as 8.8%, almost 9%. So if you're working with an advisor who's encouraging you to take Social Security early, as well as purchase a private annuity, this should raise some serious red flags. Because when you compare the two options, Social Security is essentially a better priced, inflation-adjusted annuity, and one that's backed by the US government. Now that we have a basis to prove that maximizing guaranteed income makes some level of quantitative sense, I want to start moving to talking about the softer side of retirement, the psychological side. In my opinion, this is the most compelling side. We've already noted that the current retirement climate makes for a pretty difficult puzzle for retirees. Most of your financial life has been living off a steady paycheck that you earn from a job. You have money coming in each month in a dependable way, and that money is far less subject to the volatility in the economy. When you transition to retirement, you are faced with a puzzle of making a certain asset base last for the remainder of your life. And it takes many retirees years to get comfortable with this puzzle. Some never do. The problem is the healthiest years of your life are at the beginning of retirement, and this is when spending and peace of mind matters most. Let's be honest, at the end of the day, retirement satisfaction might be the most important metric to optimize for. What's the point of saving diligently for decades if you can't actually enjoy the result? If the strategy doesn't create peace of mind, freedom, or fulfillment, what exactly are we optimizing for? Well, the data is remarkably clear. Retirees with higher levels of guaranteed income tend to report higher levels of happiness and satisfaction. The charts on the screen show this across multiple sources. The first, from Towers Watson, tracks retiree satisfaction based on how much of their income is annuitized. You'll notice a clear pattern. The more guaranteed income a retiree has, the more satisfied they report being, with a consistent 10 to 20% point increase over those with no annuitized income. The second chart from Pfau and Fink shows retirement satisfaction by the dollar amount of protected income above Social Security. Again, we see a steady increase in satisfaction as the amount of guaranteed income rises, moving from negative satisfaction at low levels of income to strongly positive satisfaction at higher levels. Now, why is this happening? Is it because retirees are used to receiving a paycheck and prefer that structure? Is it because guaranteed income helps them tune out economic noise and market volatility? Probably both and more. But whatever the cause, the quote-unquote happiness advantage of guaranteed income is real and well documented. Then Blanchett and Fink take a step further. Instead of asking retirees how they feel, they looked at how retirees behave, specifically how much they actually spend and consume in retirement. Their findings are striking. Retirees with the same level of wealth spend almost twice as much when it's held as guaranteed income rather than investments. Why? Two big reasons. Number one, rational logic. Guaranteed income protects against longevity risk, giving retirees permission to spend more freely. Then there's also behavioral ease. It's simply easier to spend income than to draw down a pile of assets that feels finite and fragile. In fact, in one survey, 59% of retirees said they feel more comfortable spending an extra $10,000 in guaranteed income, but not from equivalent savings. Same money, but totally different behavior. Now, that's some powerful framing. So here's the bottom line. Guaranteed income isn't just about safety, it's about the quality of life. It can give you both the confidence and clarity to spend in alignment with your goals. So you don't just retire on time, but you actually retire well. Then finally, just to pile on some more data, JP Morgan found very similar insights in their annual guide to retirement. Retirees with more guaranteed income in the $1 million to $3 million asset range tend to spend upwards of 40% more on a median basis. In this way, guaranteed income can be thought of as a license to spend, which only adds to the academic case being made across a lot of these studies. So what should we take away from all of this? My goal with this video isn't to convince everyone to run out and buy a bunch of annuities. Far from it. But my hope is to challenge the common assumptions that many retirees carry into retirement. There's often a strong bias towards, let's say, filing for Social Security early, lump summing pensions for maximum flexibility, and then dismissing annuities outright as high commission sales products. These decisions might feel right in the moment, but as we've seen from the academic research, they can come at a real cost, both financially as well as emotionally. What the data suggests is simple but powerful. Guaranteed income, when used thoughtfully, can help retirees spend more, worry less, and feel better about their plan. That alongside of oftentimes better retirement outcomes. This doesn't mean handing all of your assets over to an insurance company. It means asking deeper questions about what kind of retirement you want and whether your current income strategy is truly aligned with that vision. If you found this video helpful and want to explore how different income strategies could align with your personal goals, click on this video right here. I'll walk you through 5 distinct distribution strategies and help you think through which one might best support the retirement lifestyle that you're aiming for. Click here to dive in, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.